A very happy day to all of you and welcome to my YouTube channel. In today's video, we're going to take a look at the two of the largest equity markets that are in the world, the New York Stock Exchange and the NASDAQ. Both the securities exchanges are based in the United States and account for almost 10% of the globally traded equities. So are these two exchanges exactly identical? What are the differences between doing a trade on the New York Stock Exchange versus the trade on the NASDAQ? So in this video, let's take a look at what are order-driven markets, what are quote-driven markets, and a brief overview on the settlement process on both these markets. In an investment bank, traders deal in equities, bonds, foreign exchange, and commodities. As you can see from these images, there are prices that are flashing across multiple screens, charts that are showing the price variations, and dealers pacing up and down as asset prices increase and decrease in a flash of a second. These activities are conducted by the dealers in a department called as the dealing room, which is the most profitable division in an investment bank, as investment banks take on trades in both the client orders as well as in the proprietary trades. The Securities Exchange in the United States primarily comprise of two of the largest markets in the world, the New York Stock Exchange and the NASDAQ. Now, I would like to point out to you one small difference. Okay, very often in the Indian context, we call it as a share market or a stock market. But that term is now no longer being used by global investment banks. This is because the term market tends to denote that we are physically going to a marketplace to do the trade, which used to happen till the 1990s. But now most of the trades are done electronically, and the electronic exchange of orders resulting into a trade has caused the term share market to now be replaced by securities exchange. So if you are working in a global investment bank operations, either in Gurgaon, Bangalore, Chennai, Pune, Hyderabad, etc., please remember that the term that is used is securities exchange and not stock market or share market. Because this is also because the New York Stock Exchange, NASDAQ, in the Indian context, the NSE and the BSE are basically trading platforms. What do we mean by trading? Trading means buying and selling. Platform means matching the orders. So both these securities exchanges are trading platforms for trading in equities, bonds. Some of them also have foreign exchange trades, and NASDAQ also has a segment for cryptos. Yes, they've also joined the bandwagon for cryptocurrency trades. Let's take a look at NYSE. NYSE has a market capitalization of $28 trillion. This is the volume of trades that take place on the markets on NYSE. The NYSE is an order-driven market. There are automated trading systems which match buy and sell orders. I've already made a video on the NYSE trading systems, the link of which is shared in the comment section below. So what is an order-driven system? In an order-driven market, buy orders are inputted by the traders. The buy orders comprise three important inputs: what you are buying, what is the volume that you are buying, and what is the price that you are buying. So in a buy order, you are clearly indicating what is the intention. That is your intention to buy the underlying asset. Sell orders are also inputted by traders, which contain the exact same inputs: what we are selling, how much, and what is the price at which we are selling. Now, both the buy orders and the sell orders are matched by the trading platform technology only on the basis of the price. Okay, price is the single most important factor. In fact, it is the only important factor for matching of the orders. Once what is matched, how much is matched, the only criteria on the basis of which buy orders are matched with sell orders is the price. Quite naturally, volume and what you are buying is already predetermined, right? Those are the base inputs. So there has to be only one criteria which distinguishes why we are buying and selling, and that criteria is the price. There are two types of orders: market orders. The market orders are orders wherein you place the buy orders and the sell orders without defining the price at which you want to buy or sell, but the trade will take place at the market price. And limit orders. Limit orders are those orders in which the traders input the price at which they want to do the trade. So the difference between market orders and limit orders is again price. Market orders will take place at the current market price, and limit orders will take place at the price that the dealer feels is important, or the dealer wants to have the price at. So these two types of orders are in the order driven systems. So you have price order, you have market orders, limit orders, buy orders, and sell orders. Okay. So in an order driven system, the technology understands very clearly what we have to trade in, how much price is mentioned, or at the current market price. The New York Stock Exchange is an order driven market. In the Indian context, both NSE and BSE are order driven markets. Then what is the NASDAQ? The NASDAQ is the world's first electronic exchange, and it's perhaps the market where the newest companies focusing on technology, etc., are traded on. The NASDAQ is a quote driven market. Only bid quotes are displayed, and then counter quotes are asked for from other market makers. Now, what is a quote? A quote is a two-way price wherein both the bid price and the ask price are mentioned by the dealers. Dealers continuously flash these two-way prices on the screens, and market makers, who are the most integral part of the NASDAQ system, then place orders to execute on the basis of the bid and the ask prices mentioned by the dealers. Tesla, Apple, and Amazon are the top three stocks that are traded on the NASDAQ. So let's understand what is a quote driven market. The market maker is a key person. The market maker is a key person, need not necessarily be a person or an individual operating on his own. It could be an individual operating from an investment bank as well. So the market maker could be a employee of an investment bank, of a broking house, of a another bank itself. Okay. The market makers, also called as specialists, display the bid-ask quotes on specific stocks. You must remember that when they display the bid-ask quotes, they will also mention the volume of the trade. So suppose they want to trade in Amazon, they will say 10,000 Amazon, and then they will flash the bid-ask quotes. The bid price is the price at which the market maker is willing to buy the underlying stock. The ask price is the price at which the market maker is willing to sell the underlying stock. So market makers are extremely critical in the NASDAQ market because they have to continuously display bid-ask quotes. If they don't display, then they can't create a market and then they lose out on the profits. For example, a company called Athena Limited, which is a fictitious company, quotes at $30.45. The quote is $30.45 and the ask quote is $30.55. This means the market maker who has displayed this quote is willing to buy Athena at $30.45 and sell Athena at $30.55. So it is the market maker's quote. If anybody is interested in this quote, then they can say yes for 30.45 If they wish to sell, if they wish to buy, they will do it at 30.55. If you have any questions, please post in the comments box. If you want to have any more videos, especially on topics related to investment banking operations, custodian operations, fund accounting, and syndication of loans, please share your comments in the comments box. Looking forward to seeing you again soon. Thank you.